Welcome back. Today's explainer tackles a massive, highly polarized question that's sitting right at the center of our modern economy. We're asking, are credit cards vital financial shock absorbers that help us weather the storms of life, or are they predatory debt traps accelerating structural distress? It's a debate that impacts nearly every single household, and we're going to dig right into the hard data and the legal frameworks to find out what's really going on. Okay, let's dive into this. A lyric from Kanye West's track, Last Call, actually perfectly captures the complex cultural intersection of credit, status, and race in America. You know, credit isn't just about money, it's become a social identifier. But behind all the allure of the elusive black card lies a much more complicated reality about who actually gets access to prime credit and who ends up paying the highest price for it.
Here is our roadmap for today. We'll be breaking this down into 5 key areas. First, the credit crisis debate. Second, the anatomy of a debt trap. Third, race, wealth, and credit. Fourth, profiling and consumer laws. And finally, proposed paths forward.
Section 1. The credit crisis debate, claims versus data.
Right now, there is a very stark contrast in how two major organizations are viewing the exact same market. Consumer advocates, like the Century Foundation and Protect Borrowers, are declaring a full-blown debt crisis. They point to data showing that roughly 111 million Americans are trapped in a cycle of persistent debt, unable to pay their balances in full while facing record-high, industry-inflated interest rates. But the Consumer Bankers Association offers a data-driven rebuttal. They argue that if you actually adjust for inflation and account for the roughly 39 million new cardholders added in recent years, average credit card balances have remained pretty much flat over the past decade. It's a completely different framing of reality.
To really understand the scale of what consumer advocates are fighting against, just look at this staggering figure. According to a joint report, Americans have paid a cumulative total of $2.1 trillion in credit card interest since 2010. $2.1 trillion. To put that into perspective, that is more than the total amount of outstanding student debt and auto loan debt combined. Advocates argue this is basically the result of credit card banks effectively doubling their profit margins over the last 2 decades.
But the banking industry, they see this entirely differently. The Consumer Bankers Association points out that making minimum payments actually provides necessary flexibility. It doesn't automatically mean a consumer is in financial distress. Now, advocates often push for a 10% national interest rate cap, but the industry notes that because credit is priced on risk, a 10% cap would make lending economically unfeasible for pretty much anyone with a credit score below 800. That would literally cut off 150 million Americans from mainstream credit. The CBA's most crucial point here is that credit cards don't cause the affordability crisis. The real pressures are things like housing, healthcare, and food. Regulated credit cards simply act as shock absorbers for families navigating those expenses. And finally, they remind us that unpaid debt creates a loss for the lender, not a profit. The whole system relies on repayment.
Let's move to and see how this builds. Section 2. Anatomy of a debt trap. The empirical reality.
So, let's look at some empirical data from a highly detailed study of 165 cardholders from the Nizamabad district in India. The behavioral mechanics we see here are super revealing. Out of the 35 people who consistently paid their full balance, 28 successfully avoided the debt trap. But out of the 81 users who only paid the minimum amount due, a massive 73 of them fell into a severe debt trap. The data also showed a direct correlation between simply using the card very frequently and carrying a highly stressful outstanding balance. It really proves that minimum payment culture is a fast track to persistent debt.
But you know, it's not just about how you pay, it's about what you know. The study also measured financial awareness regarding things like interest rates and penalties. For those with low financial awareness, 33 out of 53 respondents reported high stressful debt levels. Contrast that with those who were fully aware of how their credit terms actually worked. 45 out of 67 reported low debt levels. The takeaway here is undeniable. Financial literacy and awareness play an absolutely crucial role in preventing excessive credit card indebtedness.
Section 3. Race, wealth, and credit. A systemic lens.
20-1. That is the massive, documented wealth gap between white and black Americans following the 2008 financial crisis. According to the UNC Law Review, this disparity isn't just an accident, it's actually the result of a long history of systemic economic exclusion.
Now, what's really interesting about this dynamic is how historical laws and policies essentially cemented racial economic inequality over generations. This overall lack of generational wealth means that many lower and middle-class Black and Latino families have a captive reliance on credit just to meet basic subsistence needs or to handle sudden emergencies. And because they are captive to this need, they are uniquely vulnerable to exploitative fees and terms. And what's wild is that this inequality is increasingly being driven by invisible algorithms. Consider the data mining experience of Karen Morton, a 33-year-old Black lawyer and homeowner. When she clicked on the Capital One website, their algorithm incorrectly profiled her as a retired high school graduate and offered her cards with an eventual 24.9% interest rate. Meanwhile, Thomas Burney, a white consumer, was profiled by the exact same system as a college graduate who skis and was offered a card with an 11.9% rate. This perfectly illustrates how modern data mining can unintentionally perpetuate structural racism by offering vastly disparate terms based on demographic profiling.
Section 4. Profiling and Consumer Laws. The UNC Law article highlights several high-profile incidents to anchor the really dense legal discussion about consumer profiling. Back in 2013, a 21-year-old Black nursing student named Kayla Phillips cashed a tax return and bought a highly coveted $2,500 Celine purse at Barney's in New York. Just 3 blocks away from the store, she was stopped by undercover NYPD officers and accused of credit card fraud, literally just for making a purchase. Barney's eventually settled her case for $500,000.
Similarly, Robert Brown, who is an actor on the HBO series Tremmy, bought a Movado watch at Macy's as a graduation present for his mother. After the purchase, he was accused of theft, handcuffed, and paraded through the store by police. Consumer advocates use these deeply humiliating real-world anecdotes to impartially illustrate their claims of a nationwide pattern of racial profiling. It's often dubbed shopping while Black, where non-white consumers are treated with inherent suspicion when utilizing credit.
And the data suggests this profiling extends all the way to the end of the credit life cycle, debt collection. Maria Guadalupe Mejia, a Latina from Missouri, was relentlessly harassed and sued by a debt collection agency over a $1,000 debt she never actually owed. She lived in constant terror of losing her home or being arrested. A jury eventually awarded her $83 million in damages. But the broader survey data presented in the UNC article notes a really disturbing trend. Debt collectors reportedly hound Black borrowers more frequently than white ones, which adds just another layer of distress to an already fraught system.
Section 5. Proposed Paths Forward. Divergent Solutions.
The UNC Law Review proposes a pretty fascinating concept called rehabilitative reparations. This is a legal theory arguing that traditional consumer law, which basically tries to make one individual whole after a single act of discrimination, is fundamentally flawed. Instead, this theory proposes systemic relief. If a credit card company or a corporation harms a demographic, they must make significant structural investments back into those specific communities to remedy the underlying institutional racism.
So when we synthesize all our sources today, we are basically left with 3 vastly different paths forward. First, the Consumer Bankers Association argues that the market works, but consumers just need better education on existing tools, like balance transfers and 0% introductory rates, instead of policies that would restrict credit access entirely. Second, the Century Foundation takes a much more aggressive regulatory stance, demanding a strict 10% national interest rate cap to stop what they view as extreme profiteering. And finally, the UNC Law scholars call for an amendment to the CARD Act that would enforce those rehabilitative reparations we just talked about, and include slavery disclosure laws to force real corporate accountability for systemic racial harms.
And that brings us to our final thought, leaving us with one ultimate question. Is the consumer credit system fundamentally broken, functioning as a predatory trap that basically exploits historical inequalities? Or is it a deeply misunderstood, highly regulated tool that acts as an absolutely essential economic shock absorber for millions of families? The data paints a highly complex picture, and the answer might just depend entirely on where you sit in the economy. Thanks for joining me today. Keep asking the hard questions, and I'll see you in the next explainer.